Hello guys and welcome back to another video. Now of course it is earnings season, and so today I'm going to be doing a deep dive analysis into the behemoth that is Amazon, giving my qualitative and quantitative analysis over the company, and at the end of the video I'll provide you with my opinion on what the company is worth and whether it is undervalued or overvalued at the current share price. So without further ado, let's get into the video. So if we just kick off with the qualitative analysis, guys, I'm not going to spend too long on the qualitative side of things in this video, just because I think I spent a little bit too long on this piece in the Facebook video. So we'll just get straight into it. In terms of the background, I don't think Amazon needs an introduction. Everybody knows what Amazon are all about at this point. But in terms of some of their sort of divisions that they have, so they've got their main e-commerce side of business. They've got cloud computing, which is with their Amazon Web Services. They've got digital streaming through Amazon Prime, artificial intelligence. They're also looking to move into the pharmaceutical industry. So pretty much any sort of industry, any pie that they can get their hands on, you can trust that Amazon are going to be looking at it, which is good. It means that their business is well diversified. So that is a tick in my book. In terms of management, so we've got Jeff Bezos, who is the current CEO. Although he is stepping down in the second half of 2021, but he is maintaining his role as a chairman in the business, which is good. Of course, he founded Amazon, and so he knows the business inside out. He understands the vision. He created the vision, and so it's good that he's going to hang around effectively. Then we've got Andy Jassy, who is to replace him, and he is the current CEO of the Amazon Web Services division. And he's been with the business since 1997. So again, knows the business inside out, and I think that's an excellent replacement. So it's a tick there. And then we've got Brian Osflasky, who is the CFO. Again, he's been with the business for a long time, since April 2002. And so again, and from this isn't all of management, but from a management point of view, Amazon's is just fantastic. Now, if we want to look at insider trading activity and insider holdings, we can do that. And you can see here that Jeff Bezos owns 53 million shares in the company, which is phenomenal. That equates to around $190 billion at today's share price. So massive holdings, which is good. It means he's very well vested in the business, which means that he should act in the best interest of the shareholders, which will only go to increase shareholder wealth. So that is a big tick. In terms of sort of insider transactions over the past year or so, hasn't been an awful lot going on, which is never a bad sign. There were $1.5 billion worth of stock sold in Q1 2020. And I think that is relating to Jeff Bezos' divorce. So again, that's not an issue at all. Other than that, there hasn't been many transactions. So that's a good sign. It means that management believe that the price of the Amazon shares at the moment are at least fairly valued, if not undervalued. So that is a good sign. Just going back to the qualitative sort of analysis that we've got here. So I've just noted down some risks. So we've got, I've said the first one to be sort of sellers moving away from Amazon into other competitors. So we've got Shopify. And we've got an article here which just goes to show the sort of competition between Amazon and Shopify. And analysts believe that Shopify's revenue is due to increase by almost 3 times within the next 3 years. So that is phenomenal growth. And presumably that growth sort of has to come from somewhere, although it's not necessarily a zero-sum game. But it's fair to assume that Amazon could be impacted by Shopify if Shopify continues to grow at the rate that they are at the moment. Of course, at the moment, Shopify is so small compared to Amazon. But you have to sort of think 5, 10 years, 15 years down the line, will Amazon still be the dominant player in the game? So that's something to think about. And then another risk to the business that we've got is sort of authorities taking regulatory action against Amazon. So this is one example of it here, where we say that the EU takes action against Amazon's dominance as regulators get tougher. And there's been a lot of talk in the media about breaking Amazon up. effectively they're becoming too dominant, and authorities don't like that. So there is always the risk that all of these different divisions that Amazon own will have to be broken up. So that is something that we need to sort of consider before making any investment decisions. And then another risk that I've sort of noted down, but it could be considered as an opportunity as well. It depends on how you sort of see things. But Amazon are always looking to move into a load of different industries, which can be great for diversification and growing the business, but it can also result in sort of moving into businesses that they just don't understand very well and not performing very well as a result. So that could potentially harm the business. But with that being said, on the other side of the coin, I've also put it down as an opportunity here. So I said that they are one of the biggest brands in the world, which allows them to disrupt many industries and diversify their business. For instance, cloud computing and the pharmaceutical industry. So it depends how you look at it. Everybody has their own opinion as to whether it's a good thing for businesses to go into so many different industries or not. That's a decision that you would have to make yourself. Another opportunity is that Amazon are highly likely to retain the significant transition by many people to online shopping due to COVID-19. So although people will soon be able to just go to the shop, or they already can go to the shops, there's a high likelihood that many people will have realized how easy it is and how convenient it is just to order through Amazon. You place an order on your phone and it can be with you in the same day. So just the convenience of Amazon, I think that a lot of people will now transition across to Amazon, and Amazon will see the growth of that as a result. Okay, so moving on to the quantitative side of things. So as you can see here, this is my discounted cash flow model. I'll talk you through very quickly each of the inputs into the model. So current share price, I've noted down here as 3,553. If we just check that as of right now, I think we've actually got 3,507. So for the purposes of this, I'll just update that. It's not going to make a massive difference. It's not a big change. 1 to 5 year revenue growth, I've said 30%. And I have considered analysts' estimates. So if we look on Yahoo Finance, we can see that, yes, analysts are expecting growth over the next 5 years per year to be 38% compounded, which is just unbelievable growth. If we sort of consider what their results were most recently, so we can see here that in their most recent quarter, Amazon sales surged 44% as it smashes earnings expectations. So revenue grew 44% in the most recent quarter in comparison with the year before. And earnings grew significantly as well. So earnings were $15.79 per share compared with $9.54 per share, which was anticipated. So that's, 50% increase on expectation. So their earnings were absolutely amazing, which seems to be a common theme with all of the big tech companies' earnings this week. And revenue was also a large beat as well. So that's fantastic. With that being said, I do think that 38% year on year for the next 5 years is quite high, and so I've reduced mine sort of expectation down to 30%, and there is a reason for using 30%. So if we actually go into their earnings report, and I think it's on page 10. Okay, so on page 10 they've given us some guidance. And they say here that net sales are expected to be between $110 and $116 billion, or to grow between 24 and 30% compared with the second quarter of 2020. So I figured that I'll go for a more conservative estimate for the next 5 years. Although analysts think it's going to be 38%, I'd prefer to be a little bit more conservative. I'll go with 30% growth. Absolutely fine. In terms of 6 to 10 year revenue growth, I've just reduced that down to 20%, just to be conservative, because it's difficult for companies to grow at that rate when they're getting so large. In terms of gross margin, I've used the average of the previous 5 years, and it's fairly consistent. So I feel like I can be quite confident on gross margins going forward. Similarly with operating expenses, I've used 20% in my forecast. And again, that's the average of the previous 5 years. I think that seems reasonable. Free cash flow as a percentage of revenue, again, average of the previous 5 years. There aren't really too many peaks and troughs with the exception of 2017. So I think that 7% seems fair there as well. Terminal growth rate, 2%. I pretty much always use 2%. I mean, it depends on which economy they're primarily operating in, but 2% is reasonable as a terminal growth rate. So long as it's below the growth rate of the economy, I'm absolutely fine with it. Weighted average cost of capital, I've done a calculation here. I won't go into the details of how that calculation was done unless it's sort of requested. But ultimately, weighted average cost of capital for Amazon, 7.6%. So on to tax rate. Again, tax rate is the average of the previous 5 years, relatively consistent with the exception of 2016. But I've included that in there anyway because I think that a tax rate of 19% going forward seems fairly reasonable. Which brings us on to these sort of illustrations here. So as I said in the previous video, I like to see strong revenue growth, strong earnings growth, and strong free cash flow growth. And if a company has all of those three things, then that's when I start to really get excited. So Amazon absolutely smashes revenue growth out of the park. Earnings growth is also looking very good, although slightly more choppy. And free cash flow growth, again, looking absolutely fantastic. So tick, 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 starting to look very good. So that brings us to the results of the DCF. Present value of the 10-year future cash flows, when you discount it at the weighted average cost of capital that we've calculated, $683 billion. Terminal value, $2 trillion, which gives us a net present value, a total net present value of around $2.7 trillion. So according to my DCF model, Amazon is worth around $5,200 per share. Let's try and remain on the prudent side of things. We also look at an earnings multiple. So I look at what I think that their earnings are going to be in 10 years time from now. And I believe that that will be $125 billion per year, according to my forecast. Now for the expected PE ratio in 10 years time, this one is a little bit more difficult. So if we look at the historical PE ratio, we can see that the average, so the mean is 284, the median is 113, and the average between those two is 198. The reason why that's so high is because a lot of the time the business was unprofitable because it was growing so quickly. And so it wouldn't be fair for me to assume that it wouldn't be right to use these numbers. And so effectively I've just ignored that. And I've said, so let's imagine a company of Amazon size, or a company that is currently worth, in my opinion, $2.7 trillion. Strong balance sheet, strong brand, growing at what I believe will be 20% per year from 2030. What do I think that a reasonable PE ratio would be for a company like that? And I've said 35, and I think that that's probably about fair. It's up for debate. It's an opinion. That gives us a future market cap based on that PE ratio of $4.4 trillion, which is absolutely huge, which gives us a price per share in 10 years of $8,500. You discount that back to today, and that tells me that the shares are worth $4,000 per share. I've taken an average of the two methods of intrinsic value calculation, and that allows me to arrive at an estimated intrinsic value of $4,600, which is fantastic, and that would give us a margin of safety of 32%. As I always say, guys, none of this is investment advice. These sort of inputs into the DCF are just my opinion based on my sort of knowledge of the business and where I think it could grow. If we were to change some of the inputs into the DCF, then the outputs would change significantly as well. So as always, do your own research, take a look into the companies and take it from there. But hopefully this has been somewhat entertaining, somewhat useful for you guys. And yeah, until next time.